Well, hello and welcome back to FinSpire's Focus on the Market series. As I mentioned in our quarterly capital markets analysis for the fourth quarter of 2021, that we'd be having a special session on inflation. And so that's what brought us here today. It's a very timely and topical item for discussion, but also a very popular item for discussion that we're having, not just with our corporate retirement clients, but also with our individual clients. And so with that, I wanted to bring some additional resources, shed some additional light on the concept of inflation and how it's impacting portfolios and what to do about it. Because we hear about it quite a bit, but it's something that I think it's going to benefit all of us to have a good discussion around because, quite frankly, inflation is not something that's really impacted portfolios for almost 40 plus years. Since we've had a period of what's called stagflation in the 1970s. So I'm Chris Karam, Chief Investment Officer with FinSpire. I'm glad you're with us today and you had a chance to view this video. As you can see, I'm joined by a special guest. Garrett Nelson is here with us from Natixis Investment Managers Solutions. Natixis is a nearly $1 trillion asset management firm, global asset management firm. Garrett spends time not only in the capital markets and assessing concepts like inflation here, but also sits on their investment committee. So I'd like to welcome Garrett to as a special guest to the Focus on the Market series once again. Garrett, thanks for joining us.
Yeah, happy to be here. Thanks for having me, Chris.
Great. Well, let's jump into it because there's a lot to go through, but we're going to try to break this down into manageable slices. Right? Because people hear this broad term of inflation. In our world, especially on the pension side, we're able to measure things like pension liabilities and funded status in numerous ways. It can be really confusing. And I draw that parallel because inflation is one of those concepts, economic concepts. I feel like it's the same thing, right? We have various economic statistics. You can measure in a variety of different ways. Two of the most common ways people hear is something called the Consumer Price Index or CPI. Right? CPI impacts everything that we do, especially when it comes to things like Social Security adjustments at the end of the year. And also something called the Personal Consumption Expenditures or PCE. And there's a whole bunch of other ways to measure inflation. So what have you found with these measurements of inflation and other things that you may find interesting when it comes to just evaluating different measures of inflation in the economy?
Yeah, absolutely. So brought a couple of slides along. So let me pull up a few that I think will help to really frame that conversation here. First off, I think it's really great to set the stage in terms of what inflation really is. And when you think about it, it's not the level of prices that you pay for all these different items out there, but it's the rate of change of those prices. That's what really matters here. And so, especially today, and really over the last year and a half, I feel like I've had a lot of conversations, even with market participants, that really have to be very specific about that definition, because everybody's focusing on these pretty significantly volatile price changes. But the key here is understanding whether those changes and the rate of those changes is going to be persistent. That's where that kind of transitory argument comes in that you probably heard thrown around quite a bit with the Federal Reserve. It's not, are we seeing prices that are going to be moving up for a couple months and then that's kind of the new baseline? It's, are we going to continue to see prices increasing 3.5%, 4%, 5% every single year over year? And that's what really matters from us as investors and also to the Fed in terms of setting policy decisions. But I think it's important to understand what really drives those price changes. And so, Chris, you mentioned PCE, that one measure, and that's the Fed's preferred measure of inflation. The one that we typically hear about quite a bit in general media would be CPI, so consumer price inflation.
Right.
And all that is a basket of all these different consumption goods that you and I spend our money on a daily basis. And in this first chart, we've simply done two things. On the x-axis, so going horizontally, we've kind of scaled each of these different baskets by the percent of that basket they represent. So you'll notice the light blue is housing, represents almost a little over 40% of the market of that basket. So that's really a key driver of inflation. You'll notice the bars moving higher. That's the rate of change. That's the inflation rate on these different baskets. And you'll notice one really stands out head and shoulders above the rest. It's transportation. And if you've been following any of the headlines, that's probably not much of a surprise if you think about airline fares, you think of recreation, that falls fine display into this darker blue. But all these areas that are kind of related to the pandemic, and all these items and areas of the economy that we couldn't spend money on during the pandemic, that's where we're starting to really see those surges. And the other one that's really been front and center and high profile has been obviously the automotive sector. And that's been weighed on certainly by some very specific supply chain issues, but we're starting to see some of those supply chain issues spread out a little bit more here. But I think it's helpful to understand it's the rate of change in prices that matters, how long and how persistent that matters, and where you see those baskets, what's really driving inflation really does matter here. And I think this first chart really helps to put that into perspective. The last thing I'll mention, just to keep things brief here, and I have a number of different charts, but I think there's a couple things that really help to frame this as well. If you go back into the early stages of the pandemic, we actually saw prices decline very significantly. And so as we came into this year, we were talking to investors and clients about how we see these base effects. So because prices fell last year, that would artificially inflate price changes this year just because of the year-over-year number. And you can see that play out here. You can think of this kind of light blue line as the cumulative change in prices, the actual change in prices. And the purple line is that cumulative change. So you can see it's actually taken us until really last month to get back to the price levels we were at prior to the pandemic. So it's actually kind of a matter of making up for lost ground in terms of price losses during the peak of the pandemic. So I think it's interesting to kind of frame it in that perspective as well. It feels like significant price gain, but if you actually go back, we're just making up for some of the price declines that we actually saw at the peak of the pandemic. So a lot of different moving parts here to consider.
Yeah, that's very interesting, right? So that we're playing a little bit of catch up here based on, at one point in time last year, the price of a barrel of oil went to negative $37, right? And during the heart of the dearth of the pandemic, and so perhaps we are making up some lost ground here. But what if the question I posed last quarter at the tail end of our capital markets review was, well, what if they're wrong? What if the prognosticators are wrong about this is what they call transitory? It seems like it's hard for inflation to be transitory because you just get the step up in prices, right? Well, and everything kind of grows from there. Well, you put up one of the interesting charts you have established here is how to measure sticky versus flexible inflation. You mentioned that it's important to know not just what the inflation rate is, but is it moving higher or is it moving lower? And so if you could walk us through a little bit how your team dissected this concept of sticky inflation versus flexible inflation, if you get a moment.
Yeah, absolutely. So you can see that slide up here, and it's a pretty striking slide, to be honest. Luckily, the Cleveland Fed did some of the heavy lifting in terms of kind of dissecting that inflation basket and all those different goods we talked about earlier. And essentially the idea here is the purple line is tracking goods and items that we spend money on that tend to see price changes much more rapidly, and vice versa for the light blue line. That's areas of the economy and items that we spend money on, goods and services that we spend money on, that tend to adjust much slower. So if you think about it, what tends to represent these baskets, that sticky price is things like medical services, education, personal care, certainly housing. Those are all portions of the economy where the prices take a lot longer to adjust. And so it's not all that surprising that what we've seen is actually those sticky components, well, they haven't really moved a whole lot, hence the name. What's really driving it is a very, very significant increase in all those flexible items. And I think this ties really nicely into this next slide. It's also somewhat of a story of durable goods and consumption goods versus services. So what have we seen? Well, services, and this is excluding the commodity sector, so energy prices. You can see we're pretty much back to where we started prior to the crisis in that purple line. What's really been the market increase is durable goods. And if you think about it, again, going back to that auto sector, there certainly are some significant constraints on manufacturing from the labor side, on getting enough people to produce good, but also from supply chains on a global basis and shipping disruptions and certainly all of those headlines I'm sure many of you are familiar with. So what's really striking to me is we were really in this period of a decade plus where we saw durable goods because of technology and gains and cheap labor and manufacturing costs. We were actually in outright deflation. Prices of goods declined.
Right.
What we've seen that actually spike to really significant levels of inflation driven by goods. So I think it gets back to that story of, is that really a sustainable backdrop? Has everything really changed to where we're now in this new regime where goods are going to sustainably and persistently be increasing, a couple percentage points a year? I think that's a little bit of a tough argument to make that we've seen that market of a change. It's just interesting to really consider what's been driving it, and it's all those goods that you tend to see rapidly adjust to dynamics from labor supply and goods demand and supply chain issues.
Right, and we hope that some of this reduction, right, in contribution to CPI, we certainly hope that continues to tail off a little bit into something that's healthier, right? You don't want deflation because that's a tough one to get out of, and so this is a difficult balancing act for all those who have a lot at stake into managing the keeping inflation under control. You mentioned something about of course, the current events, right? All the bottlenecking that's occurring. We now see shipping issues, especially off the west coast of the country with the delays. But you break this down into some, COVID sensitive type inputs in your charting, and tell us what you found here. And is this just a classic case of just too much demand chasing too few goods, too many dollars chasing too few goods in the short run, or and just as a result of some of the bottlenecking and COVID sensitive inputs that we're experiencing, or is it something different?
Yeah, it's a really good question. And again, some of this research we pulled from this time one of the other regional reserve banks. It's coming from the San Francisco Fed. And they did some really interesting research trying to break down the sensitivity again of some of those items to the pandemic. So as the pandemic set in, did they actually see prices adjust or not? And that's kind of how they delineated between the two. A lot of statistical work on the back end of it, but it's a pretty basic idea at the bottom line. And what you can see here is all those items that are really sensitive to the pandemic, that's what you see here represented in the purple bars. And those items that are really not sensitive at all, really haven't been impacted, that's what you see in the light blue bars. And so the basic idea here is, if you actually strip out the effects of the pandemic, that's what you kind of want to see and focus on for the light blue bars. And yes, have you seen a little bit of an increase? You have, but you've also actually started to see that peak out and roll over. What's really more interesting is the significant increase we've seen in the purple bars here. And that really does suggest that underlying a lot of these price pressures, inflationary pressures, is simply the pandemic itself. And if we start to get the pandemic under control, we start to normalize all of these disruptions. And certainly it will take some time, all those shipping delays and supply chain delays, it will take some time. But if you get the COVID, underlying healthcare issue under control, you should be able to get rein in control on these price pressures. And another way to look at it a little bit more granularly is, again, as you mentioned, is it really the demand side or is it the cost side, right? The supply side. And they tried to dig into this a little bit deeper here. So the same idea, you can see that light blue line or bar is the same. Is that the insensitive basket? We've broken down the sensitive basket into, is it really demand driven? And that's what you see in the purple bars here. And you can see, yeah, absolutely, we're seeing a lot of that coming from robust consumer demand. And then a little bit on the supply side, here represented in the dark blue line. And then the ambiguous is where it's a little harder to delineate. It's probably a little bit of both. So the bottom line, to answer that question, is we know the consumer is in very, very healthy condition. Balance sheets have really never been healthier. We know there's a lot of pent-up demand and consumer spending out there. And that really does suggest that probably some of these pressures are from the demand side. I'd argue that probably a lot of these gray bars that you're seeing here probably fall into that blue portion where there's a little bit of demand. It's probably more so supply. That's really been the biggest issue. Is these bottlenecks are driving some really, really outsized moves for very, very small portions of that consumption basket. And that's what's really driving some of these high headline inflation numbers. So again, getting back to it, it's a little bit of both. I'd say that the supply side is probably the bigger issue because under normal circumstances, the supply side to ramp up and meet that demand, you probably wouldn't have as much in the way of inflationary pressures. But right now, there simply are a lot of different headwinds for various different industries. And that's ultimately leading the supply side to be constrained, and that's what's placing the upward pressure. How do you fix it? Again, get the healthcare crisis under control, and we should eventually see some normalization. But yes, it will take some time and probably a little bit longer than we hope.
Yeah, supply certainly is a supply lack of has been challenging, but also that there's been an unprecedented level of demand, right, forced into the economy through government interference, whether it's through the Federal Reserve or through Congress injecting trillions or borrowing trillions really into to actually create and stimulate additional demand. And another way is to look at it too is that with not all, but some of the government incentives and stimulus and relief measures are starting to taper off. And that is also been an interesting item as we talk with our clients about the labor market, right? So as some of these demand stimulating measures that the government has really pushed forward since March and April of last year, some of those are starting to wear down. But it begs the question with this challenge that we have in the labor market, right? And we were always trained that from an economic and finance 101 perspective, that if wage growth starts to creep above 4%, that is one of the surefire ways to trigger inflation, right? And to actually, because it might actually, and at the same time, trigger a reduction in corporate earnings. So just curious on what you're seeing on the wage front, because this does have a ripple effect into some of the labor shortage that we have right in the country, and that could, and what kind of jobs are experiencing the most types of wage inflation.
Yeah, this is a really important point, and this is what, in our opinion, really drives persistent higher levels of inflation. Is do you see consistent and persistent gains in wages across the spectrum? So there's a couple things that we're keeping a close eye on. One of them is the Atlanta Fed put out this median wage growth tracker, and this gives you a really good apples comparison of actual wage growth. There's some of the other data that comes out that we got last Friday. You tend to see some distortion from compositional effects. So
sure.
If you move low-paying jobs, you might artificially see wages increase. This is trying to strip that all out and give you a really good sense of what actual median wage growth is. And the bottom line is actually kind of been trending in this kind of channel for going on 4 or 5 years here. So by no means have we seen that wage growth really exploded to the upside. What we have seen, and you can speak to some of those labor supply constraints, is there are portions of the workforce that have seen some pretty significant wage gain. And where has that been concentrated? Well, again, this really kind of boils down to COVID as the underlying issue here. A lot of the wage gains have really been taken down by those lower skilled jobs that we see here in that light gray bar. Mid and high skill, pretty much been trending sideways, actually softening a bit in recent months here. So not broad-based wage gains, really targeted in lower skilled jobs. Again, if you break down wage growth from various income bands, so on this chart, you're seeing that light blue line that's been moving higher. Those are the lower wage earners. So yes, they're seeing pretty sizable wage gains, but keep in mind, it's on a relatively low base in terms of what those actual salaries are. So as it translates to consumption and demand, it's helpful because those lower wage earners are going to be spending a larger portion of their paychecks. But again, those are smaller components if you consider overall consumption because they're smaller paychecks on kind of a total headline basis as you compare it to some of these upper band higher income earners. Again, if anything, a little bit of flat line to slightly softer. And one other way to think about it as well is you're actually seeing some incomes for younger workers in the workforce. And this is actually kind of backfilled the fact that we've had some of these labor supply constraints. We've actually seen teenage workforce participation rate increase. And you're seeing that some of those wage gains are actually going to, young high school and college workers. And so again, translating that to demand is helpful, but it's not really the real broad-based wage growth that really drives persistent higher levels of inflation here. So I think that's really the key, is if we're going to see sustained rate of inflation at higher levels than what we've been accustomed to over the last couple decades here, this is really what needs to change. We need to see wage growth really moving meaningfully higher. Right now it's really just targeted at some of these specific industries, services, leisure, and hospitality. That's going to be helpful for demand, but it's not going to meaningfully change that kind of inflation backdrop in our opinion.
Mm-hmm. Yeah, interesting there too to see that the 55 plus, perhaps embedded in there, and we've heard this anecdotally. We see some data that supports it, but perhaps a few additional early retirements, perhaps than anticipated over the last couple of years, whether it was health related or whether it was just the fact that, hey, account balances are up in 2020 and in 2021, even despite everything. Maybe this is a time where if I was thinking about retiring and spending more time with the family, maybe it's a good time. So it's interesting to see that cohort in particular actually could just decline, right? And pick up here real briefly recently, but you see a pretty significant uptake in that 16 to 24 age cohort, perhaps trying to fill some of the gap left from the jobs that are open today. So you touched on a little bit, Garrett, but just to conclude on this is inflation going to be persistent? Are higher levels of inflation going to be persistent? And it seems what you're saying, based on the data that you're sharing here, is that perhaps not. Perhaps it will taper a little bit lower. It just may be around for a few more months or quarters than perhaps originally anticipated.
Yeah, I think that's the right way to characterize it. I'm still somewhat in the camp that it's really difficult to forecast, and I think we've seen that throughout the crisis. Whatever the data is, earnings for corporates or any sort of economic data, it's been incredibly hard to forecast. But I think especially with prices, it's less so right now an indication of actual inflation as it is just kind of a mishmash of demand and supply imbalances as we continue to try to emerge from the shutdown at the early stages and try to combat the health crisis. So, I still think that the informational content is still somewhat limited because of that. But again, getting back to it, I think that we're moving in the right direction. A lot of the supply chain constraints I would expect to start to fade. But to your point, a lot of these probably stick around for a little bit longer than expected.
Mm-hmm.
So the one thing I would say is that we are pretty optimistic on the outlook for demand. And I think the consumer and the household is in very strong shape, and that should continue to really support overall economic growth. And that might lead to inflation being a little bit stickier as we continue to work through some of those imbalances. But eventually, I think we'll be able to get to a point where these corporates can adjust. We eventually work out those kinks in the supply chain, and we can probably start to normalize back towards something similar to what we saw and were used to prior to the pandemic.
And then let's talk a little bit about, as we conclude here, just portfolio management, right? That's our business, right? All these things impact client portfolios, whether it's through higher levels of inflation decaying someone's ability to maintain cost of living standards, all the way through impacting the equity markets, right? Of having an inflation surprise. So, what are the traditional ways and even some newer ways that investors can manage inflation risk in their portfolio?
Yeah, great question here, and no slides for this one. I think as it goes back to it, there's obviously traditional inflation hedges. I think the one that probably comes top of mind is Treasury inflation protected securities, so TIPS. Essentially, U.S. Treasuries that have a link to CPI. That actually makes a decent amount of sense in this backdrop, just considering the fact that there's a nuance to it. Everybody focuses, and certainly the monetary authorities, the Fed, focuses on core inflation. That strips out the volatile components of food and energy prices. But TIPS are based off headline. What we've actually seen is that, obviously, with the oil prices ticking higher, the concern has shifted to energy prices, somewhat destroying demand here. So TIPS are certainly a decent way to hedge that. One risk is that investors have really piled into that market hand over fist over the last couple of months here.
Right.
So there's not a lot of value in that market. You certainly do get some of that inflation hedge, but you actually pay a pretty significant premium for it. So that's something to kind of weigh the risks and balance on. Going back to, again, kind of theory here and traditional thought on portfolio construction, some of those hard assets, real assets, are a good way to hedge. So, real estate, probably still a good opportunity, especially if you're looking at those portions of the market that have leases that reset more frequently, and that allows you to drift with inflation. And also, as you think about it, what's one sector that's really lagged behind the overall market throughout the recovery? Real estate's been that portion. So again, a little bit of a kicker because you get that inflation hedge component, but you also have an opportunity to kind of catch up with that market that's really lagged behind. I think right now, you don't have to get too crazy with portfolio construction to hedge inflation risk, because I still think it's a really good backdrop for equities to really do the heavy lifting in your portfolio. So I know the term is getting thrown around quite a bit. You kind of alluded to it earlier, stagflation. And honestly, I'm ready to mute that anytime I hear it. When I look at growth now and what we see for growth prospects next year, it is anything but slowing growth. I mean,
Right.
Yes, coming down from 10% nominal growth.
Right.
But we're probably going to see something on the order of maybe 6 to 7% growth. And that's still well above what we saw prior to the pandemic. So growth is by no means slow. it's slowing, but it's very, very strong. So
Right.
you'd even start the stagflation conversation without slow growth. So that really is still supportive of, in my opinion, equity markets do well, and that should continue to be a pretty good hedge in portfolios. I really don't think you have to get too fancy. Equities should probably continue to do well in that environment. Maybe there's some pockets that have some margin concern, but overall, I think what we've seen is earnings have been very robust. Companies can find ways to be very profitable despite some of these constraints out there in supply chain.
Yeah, and that's important. It's important for people to be aware too that equities usually are your first line of defense against inflation. And from a portfolio management perspective, and the base case still being, it's still an equity favorable environment, given not just our economic growth rate, but also relative to the bond yields that, although they've been rising somewhat here in the near term, are still relatively low from a long-term perspective. And so equities still give you that first line of defense. And then you plug in what I would say smaller probabilities, right, in your portfolio, just from a risk management perspective, to say, if this does happen, if we do get a persistent and rising levels of rates of inflation, then at least you have something in there that will track a little bit independently of even the equity market and track a little bit more favorably with an inflation surprise. But no need to say overdo it, right, in a portfolio, knowing that equities are still a really good first line of defense of managing inflation risk. Great. Well, thanks, Garrett. I really appreciate your time today and appreciate your insights. And I think the work that your team has done has been extraordinary in categorizing and slicing and dicing this inflation topic into ways that hopefully can really bring a lot of insight to our clients and to everybody viewing this video, and really appreciate your insights today.
Yeah, absolutely. Well, we really appreciate the time with you and your client. Thank you.
Thanks, Garrett. Appreciate it. We'll talk to you soon.
Great. Take care.
And thanks everybody for watching, and stay tuned for the next episode of Focus on the Market series, which will take place in 2022. Thanks for joining us, and we'll talk to you all soon.